sponsors. I'm also very proud that CNBC is a partner as well. And now I'd like to introduce a man who has been one of the greatest supporters of this event. He's here, I think, every year, certainly since I've been coming here, and that is David Einhorn. David, come on out.
This isn't going to work. I'm really excited to be here. We're live here at the Sohn Conference. Way better than telling jokes to the teleprompter. I'm wondering if anybody laughs. I'm always grateful to be here. This is actually my 20th presentation at the Sohn Conference. I never met Ira Sohn, but I've had a chance to meet his family in the years since, and it's just an honor for me every year to get to support this wonderful cause. And I think they've done a lot of good for young children, now a lot of good for science. And I'm glad that all of you are here to share this with us today. So here's our disclosures. I'd like to remind everybody the ideas I'm about to present are our existing positions in our portfolio, and we may change our positions at any time. The cartoon says you have to invest for value these days, and these days I find the best value in gin and tonic. I've said that value investing industry is dead. However, value investing and the value investing industry are two different things. The value investing industry is the thousands of people that used to be employed to analyze and pick stocks by trying to figure out which ones were undervalued. Trillions moving from active management to passive have caused these people to be fired, and they're not coming back. This is what I mean by the value investing industry is dead. The cartoon says, good news, remember all those growth stocks I sold you? They are now value stocks. With all these unemployed people and their AUM gone, it's actually a great time to be a value investor. There's much less competition. There are cheap stocks that are just much cheaper than they would otherwise be if there were lots of professionals with capital to deploy trying to identify them. I will talk about one of those in a couple of minutes. When I started in this business, everyone said Warren Buffett benefited by starting his investment business when few people even read annual reports, and few were good at valuing stocks. It was a shame that there was so much competition for me. There were thousands of experienced professionals trying to do the same thing. Well, guess what? That's how it feels right now. For the few of us who are left, it's a great time to be a value investor. There is so little competition that the opportunities to buy fine companies with double-digit cash-on-cash returns are more abundant than at any time in my career other than at the bottom of a bear market. This may be how Mr. Buffett felt in the 1950s. So here's an example I'll share with you today. The cartoon says, Mrs. Rothman, will any of this be relevant once AI takes over? We find ourselves asking the same thing. I know everyone is talking about AI, and the title of my talk today is Solve AI. At Greenlight, we have always thought of ourselves as being flexible investors, willing to learn new things. AI has been the rage for the last year, and we have found a great idea. Our idea today is Solve AI, a European company that most of you have never heard of. I'm very excited to tell you about it. It's most commonly known as Solvay, whose motto is mastering the elements essential to our world. Solvay is an essential chemical company that holds the #1 position across all of its markets. Everyone wants a lesson in computer science. Instead, today we will study chemistry. I'm sure that thought excites all of you. Who besides my dad had chemistry as his favorite class? All right, so first chemistry joke of the day. Do you know why you can never trust an atom? They make up literally everything. Solvay is a 160-year-old Belgian enterprise that trades under the ticker SOLB in Belgium. The company just went through a corporate restructuring. The old Solvay was a chemical conglomerate that in December spun off its specialty chemicals business into a new company called ScienceCo. The remaining essential chemicals business became the new Solvay. The new Solvay has 9,000 employees in over 40 countries globally. It has 7 major research and innovation centers and over 90 different branded products across 5 different business segments. In 2023, Solvay had revenues of 4.9 billion euros and a 26% EBITDA margin. Solvay is best known for soda ash, which makes up around 40% of sales. It has 4 other business segments, all of which have #1 positions in their market. While these are all thought of as commodity businesses, they are higher margin and much more stable than most commodity chemical companies. All right, next chemistry joke. I know you all love compound interest. Today, we are interested in compounds. There are a few basic facts about soda ash, or sodium carbonate, that I will share with you. Solvay's soda ash and derivatives business segment is diversified. 20% is used for flat glass applications, 15% is used in container glass, 10% is used in detergents and cleaning agents, and 30% is used in industrial applications to produce sodium silicates and lithium carbonate for EV batteries. Finally, a quarter of this segment is not soda ash, but a derivative called bicar, which is sodium bicarbonate. It's used in highly value-added pharmaceutical-grade food applications. Bicar can sell for much more than soda ash, particularly for pharmaceutical grade, and its market is growing twice as fast. Soda ash is quite an essential and versatile commodity chemical. The cartoon says it's a great all-purpose cleaner, and it makes nice flavoring for gum. That's actually true. Soda ash can be produced naturally or synthetically. Natural production, which is around 30% of the market, comes from mining and purifying trona ore. The problem is that trona is found in remote locations like Mongolia and Turkey and Wyoming, which individually accounts for over 80% of the global reserves. Like most of us, before this, I thought Wyoming was mostly for skiing and rodeos. Who knew? Synthetic production, which is around 70% of the market, is more expensive, uses ammonia, and consumes 2 to 3 times more energy. Solvay today is 43% natural production and 57% synthetic production. Next chemistry cartoon, to make sure you haven't fallen asleep, although there's no shame if you're fighting it after lunch. The cartoon says, wait, before you mix them, you have to say, pow. Solvay is the largest producer of soda ash globally, with about 11% global share. Its largest competitor in the segment is We Soda, a Turkish pure play company that produces natural soda ash in Turkey and is developing projects in North America. Because soda ash doesn't cost much, but it weighs a lot, transportation adds significant cost. Transportation can add from 30 to 100% to the cost depending on the distance and the number of interchanges it needs to be shipped. As a result, the markets are regional instead of global. Solvay competes in North America and Europe and is the mostly independent of China, which currently produces about 45% of global soda ash for domestic consumption and to export to Southeast Asia. Shipping it further from China or Mongolia is not competitive. This somewhat dated chart from 2021 illustrates the soda ash market where Solvay competes. What is more important is the delivered cost of soda ash to end customers, in which includes production and transportation. You can see the difference between natural soda ash processing with hash marks versus synthetic processing on the solid bars. Synthetic is made closer to the end user, so it has lower transportation costs, but higher production costs. The blue bar represents Solvay's plants. It has a world-class synthetic production facility in Bulgaria next to the port, 5 regional plants in Western Europe next to end users, and natural production in Wyoming. Soda ash was pretty stable from 2010 to 2021 from a pricing perspective. During most of that period, Western European soda ash has been around $250 per ton, while the U.S. prices have been lower at around $180 per ton. You can see the spike in 2022 and 2023 related to both COVID distortions that created pent-up demand and also passed through higher energy costs in Europe related to the Russia-Ukrainian war. While soda ash is categorized as a commodity chemical, it's much less volatile than the overall commodity prices. Here we show the price of changes of soda ash over time in orange for both European and U.S. markets, and how they compare with the prices of commodity index in blue. The last couple of years, soda ash producers earned excess revenues and profits, which are normalizing this year. Over the next 7 years, soda ash capacity will grow about 2.5% to 3.5% per year. Most of the new trona processing projects are in Inner Mongolia and Wyoming. It takes about 3 years to ramp up a new processing plant. Solvay is adding about 7% to its capacity by expanding in Wyoming in 2025 and 2026. Soda has a couple of greenfield projects in Wyoming called Pacific Soda and West Soda coming online between 2027 and 2030. The largest expansion, which the bears are worried about, is from a Chinese company called B-Run, which is developing a greenfield project in Inner Mongolia. We don't think the Mongolian supply is all that relevant because the transportation costs to the markets where Solvay competes, particularly in Europe, are prohibitive. Excluding China, the capacity additions are between 6 and 10 million tons of annual production, which is only 1.7 to 2.7% per year, and most of it is coming on toward the end of the decade. This is the demand for flat glass used in building construction, which has been one of the most volatile key end markets for soda ash. You can see that there was a COVID-related plunge, followed by a recovery, followed by a weak 2023 due to the European recession. As we will show in a bit, while 2024 is poised to be a down profits year, there is certainly room for volumes to better recover in the next few years as construction rebounds to levels seen between 2018 and 2022. COVID has had a significant impact. Demand slowed down a bit in 2020, which drove industry utilization from 87% to under 80%. It takes years for new supply to come online, so COVID also derailed capacity additions for several years. As the global economy reopened, demand returned to trend, and utilization jumped to 88% to try to catch up. The European slowdown and inventory destocking have caused utilization to return to about 83%. Over a longer time, soda ash demand has grown with GDP. It's likely to grow a little bit above trend going forward, given soda ash's importance to renewable energy and EV batteries. Each ton of lithium, for example, produced requires approximately 2 tons of soda ash. JP Morgan projects that the global capacity utilization will rise gradually over the next 7 years as demand grows a little bit faster than supply. In working through the disclosure, this is our best take on the soda ash's historical financial performance over the last 5 years and guidance for 2024. 2019 was a below normal year, which was followed by COVID, which caused an unusual decline. This was followed by a strong recovery and higher prices. Pricing has fallen, and 2024 is forecast to look a lot like 2019. However, this time we believe this is a trough result rather than a mid-cycle result. Back in 2019, Solvay was dealing with new competitive natural capacity coming from Turkey, and it took a while for the market to rebalance. 2024 features the back end of a European recession and destocking, which already impacted 2023. Management agrees that 2024 should be the trough. Moving on to the peroxide segment, the cartoon says a tooth walks into a bar and says, "Baking soda and peroxide, keep them coming." And the bartender retorts, "Someone must have called him yellow again." I think we struck oratorical gold, finding a cartoon that covers Solvay's top 2 business segments. Peroxide, by the way, is H2O2. Solvay has a 17% market share in peroxides. It is the lowest cost producer in all regions and has the #1 position globally. The business is well diversified across all geographies. Peroxides is a high-margin business and generates a lot of cash. 40% of revenues are very stable take-or-pay contracts to make propylene oxide, an essential ingredient in plastics and polyurethane foam. 10% of the segment produces ultra-pure hydrogen peroxide used for semiconductor wafer manufacturing. The remaining peroxide business serves the pulp and paper industry and other bleaching and disinfecting applications. Solvay has a competitive moat in peroxides, and it is growing above GDP due to its positioning with HPPO mega plants that provide 65% of global capacity and its leadership in semiconductor uses. All right, next chemistry joke. Two chemists walk into a bar. One tells the bartender, "I'll have some H2O." The second one says, "Sounds good. I'll have H2O too." The second chemist dies. For peroxides and the rest of the segments, we can't go back 5 years because the disclosure does not allow us to estimate the EBITDA. So here's the last 2 years and the forecast for 2024. While this segment is small at 13% of revenues, it's very profitable with mid-30s EBITDA margins. Next up is the silica segment. Solvay focuses exclusively on high dispersible precipitated silica. Over 80% of the segment goes to low rolling resistance tires, which are more energy efficient tires used for electric vehicles and should drive above GDP growth in this business. The rest of the silica business has applications in toothpaste, food production, and animal feed. The cartoon says, "This is him," referring to a bottle of nail polish. The acetone replies, "Just so we're clear, once I clean him, he just disappears." Got it? Coatis is a standalone Brazilian business that makes green solvents and biosurfactants. It offers alternatives to petrochemical solvents. We estimate this segment has the lowest EBITDA margin. Solvay might, and we think should, divest of it at some point. This segment has industrial uses for inks, paints, varnish, and household cleaning products. And finally, we have the Special Chem segment. It's a hodgepodge of specialty chemicals that did not go to ScienceCo as part of the spinoff. There is a significant potential growth in rare earths used for auto catalysts and permanent magnets used in wind power and electric vehicles. This segment also produces elemental fluorine used as a cleaning agent in flat panel and photovoltaic production that is environmentally friendly. There are barium and strontium businesses for various industrial uses and aluminum brazing solutions. There'll be a quiz on this when I'm done. The cartoon says, "Better than changing lead into gold, I've transmuted dihydric alcohol and terephthalic acid into polyester." Okay, I have no idea what these are either, but they certainly sound like special chemicals. Are we all still awake? Okay, good. Silica, Coatis, and Specialty Chem together form the new Performance Chemicals reporting segment. Similar to peroxides, here are the last 2 years of the forecast for 2024. These businesses are not as profitable as either soda ash or peroxides, but they provide stability and diversification. New Solvay, a leaner, meaner company, provided qualitative strategic priorities and quantitative long-term targets. In terms of its strategic priorities, Solvay wants to maintain a number one position in every market in which it operates as it gains scale and further integrates its value chain. It plans to continue to improve its processes to drive costs lower and reduce environmental impact, manifested in its MyH2O2 plants and eSolvay processes. It plans to reduce costs by 300 million euros by 2028. Solvay expects to become carbon neutral by 2050 and is quantifying and measuring its ESG targets. In the last 2 years, it has already reduced greenhouse gas emissions by 19%. And it is fully hedged for carbon emission permits it will need through 2030. Finally, it expects to maintain its capital discipline and return significant capital to shareholders over time. Now, 2023 suffered from a European slowdown and customer destocking. This affected most European chemical companies. Even so, EBITDA was 1.25 billion euros and benefited from positive net pricing and lower fixed costs in an inflationary environment reflecting strong cost discipline. The company has an investment-grade rating, modest leverage, and a high return on capital. On a pro forma basis for the spinout, we calculate Solvay earned 5.4 euros per share. New Solvay started trading in December 2023, post the spinoff. There were lots of sell-side research coverage, which was mostly pretty negative. Most of the research focused on soda ash, despite that, as we just saw, around 70% of the revenues come from other products. Morgan Stanley started with an underweight rating and a €21.5 target. The report is titled Cautious on Soda Ash and runs a full 21 pages. It gives great deal on the soda ash market, its relation to energy prices, supply growth, and end market demand. The report does not mention any of Solvay's other product lines other than in a single pie chart. Bank of America, which rates Solvay neutral, published a 20-page initiation report. The first 10 pages are all soda ash. Page 11 is a pie chart showing the other businesses, which are not otherwise discussed. The balance of the report discusses CO2 emissions and shows financial analyses. The point I'm making is that while there is a reduction in soda ash prices and profits in 2024, which everyone knows about, the rest of the business is less cyclical and more resilient. The bears seem intent on completely ignoring that reality. Solvay's market capitalization is 2.7 billion euros. Based on 2024 consensus, it has just 1.6 turns of debt. Consensus expects earnings of 3.62 euros per share this year, which is around the middle of guidance. We actually think that doesn't take into account a moderate economic recovery in Europe, which we believe will keep earnings above 4 euros per share this year, which would be toward the high end of guidance. Even so, the PE is just 7 times on what we in management believe to be cyclically depressed results. Ahead of the spinoff, Solvay discussed its going forward uses of free cash flow. It expects 4 billion euros over the next 5 years. 1/3 will go to essential CapEx, including its environmental goals. 1/3 will go to the dividend, and 1/3 will go to discretionary investments, deleveraging, or additional shareholder return. After essential CapEx, Solvay expects in the next 5 years to earn its entire market capitalization in free cash flow. Just the dividend will return half the market cap, or around 10% per year, and that's before you get to the additional shareholder returns part. We believe that Solvay has above-average management for a European chemicals company. We like how Solvay has described its capital discipline, as you can see. How many European industrial companies do you know put this type of mission statement on its website? Solvay's quantitative long-term targets for the next 5 years are quite clear and achievable. In 2023, Solvay paid a 2.43 euro dividend, which is almost a 10% dividend yield, with its forecast to be stable to increasing. This is the middle of the 2028 long-term target translated into earnings. The prior peak earnings were over 6 euros per share. This year looks to be a trough at just about 4 euros per share by our estimates rather than consensus. If management executes on its growth and cost-cutting targets, normal earnings power should be in the high sixes euros per share in 2028. All told, Solvay is a commodity chemical company with a relatively high and stable margin, a high return on capital, and a good return of capital. At 6 to 7 times trough earnings and 3.7 times targeted 2028 earnings with almost a double-digit dividend yield, it seems too cheap. At twice the price, it wouldn't seem expensive, so we think this boring essential chemicals business will generate attractive risk-adjusted returns for investors. The cartoon says, well, this should create a nice little wave of panic and hysteria. We hope Solvay creates a nice little wave of dividends and capital appreciation. And if you don't buy the company's long-term targets, don't worry. Artificial intelligence could not do any better. I asked ChatGPT for help, and it said it would be challenging to provide an accurate forecast for Solvay's earnings and EBITDA in 2028. Maybe after AI solves full self-driving, it can get back to solving financial forecasting. And a final chemistry joke. Thank you for listening today.